Hello everyone and welcome to our webinar, Hedging and Arbitraging with Fuel Oil Futures. This is Ming Hui from Phillip Futures, and speaking to you today will be Mr. Travis Tey, Associate Director from the Asia Pacific Exchange. He will be sharing how individual traders like yourself can benefit from opportunities that arise from price movements in the fuel oil markets. If you have any questions through the course of the webinar, please feel free to type them into the question box. We will be having a Q&A session towards the end. And without further ado, I will hand the session over to Travis.
Hi, good evening, everyone. Thank you for attending this webinar. So today, we are touching on hedging and arbitraging with fuel oil futures. So before we look at opportunities for arbitraging and hedging, let's just take a look and understand on the fuel outlook from now until 2040. So as you can see from the chart that is on screen, the transition to a lower carbon fuel mix. The transition to a lower carbon energy system continues with renewable energy and natural gas gaining in importance relative to oil and coal. In this scenario, renewables and natural gas account for almost 85% of the growth in primary energy, with their importance increasing relative to all other sources of energy. And while natural gas grows much faster than either oil or coal, actually this natural gas will overtake coal to be the second largest source of global energy and converging on oil by the end of the outlook, which is by 2040. Now, oil increases in the first half of the outlook while moving much slower than in the past before peaking in the 2030. Coal consumption is broadly flat, with its importance in the global energy system declining. And it will decline to the lowest level since before the Industrial Revolution. Next, we will look at the growing demand for liquid fuels. Now, global market for liquid fuels is set to continue to expand for a period, with growing demand from developing economies met by increased supplies, mainly from the US and OPEC. In this scenario, global demand for liquid fuels, crude and condensates, natural gas liquids and other liquids increases by 10 million barrels per day, peaking around 108 million barrels in the 2030s. Now, all of the demand growth comes from the developing economies, driven by the middle class and developing Asian economies. Consumption of liquid fuels within the OECD resumes its declining trend. Now, the growth in demand is initially met from the non-OPEC producers, led by US tight oil. But as US tight oil production declines in the final decades of the outlook, OPEC becomes the main source of incremental supply. OPEC output increases by 4 million barrels per day over the outlook, with all of this growth concentrated in the 2030s. Now, as continued from the previous slides, consumption of liquid fuel grows. The demand for liquid fuels looks set to expand for a period before gradually peaking as efficiency improves and the transportation sector accelerates. In this scenario, consumption of liquid fuels increases by 10 million barrels per day, with the majority of the growth happening over the next 10 years or so. Now, the demand of liquid fuel continues to be dominated by the transport sector, with its share of liquids consumption remaining around 55%. Transport demand for liquid fuel increases from 56 million barrels per day to 61 million barrels per day by 2040. With this expansion split between road, equally between cars, trucks, and aviation marine. In contrast, the efficiency gain when using oil for non-combusted uses, especially as feedstock in petrochemicals, are more limited. As a result, the non-combusted use of oil takes over as the largest source of demand growth over the outlook, increasing by 7 million barrels per day to 22 million barrels per day by 2040. Now, For this, the outlook of oil demand is uncertain, but it looks set to play a major role in global energy out to 2040. Although the precise outlook is uncertain, the world looks set to consume significant amount of oil for several decades, requiring substantial investments. Now, significant levels of investment are required as for there to be sufficient supplies of oil to meet the demand. First of all, the scenario suggests that oil will continue to play a significant role in the global energy system in 2040, with the level of oil demand in 2040 ranging from around 80 million barrels per day to 130 million barrels per day. Secondly, the significant level of investment are required for there to be sufficient supplies of oil to meet demand in 2040. If future investments was limited to developing existing fields and there was no investment in new production areas, global production would decline at an average rate of around 4.5% per annum, implying global oil supply would be around 35 million barrels per day in 2040. Now, closing the gap between this supply profile and any of the demand scenarios in the outlook will require many trillions of dollars of investment over the next 20 years. Now, after looking at fuel oil outlook, we are going to introduce fuel oil futures, which are APEX. We have just launched it on 11th of April 2019. What is this fuel oil futures is about? Well, you can see from the screen, this is our contract specifications with the contract size of only 10 metric ton per contract. It is quoted in US dollar with the minimum price fluctuation of 10 cents. Now, trading timings ranges from Singapore timing, morning 9 to 12:30, and from afternoon 1:30 to 6, and also nighttime 9 to 11. Now, the last business day of this contract the last business day of the front contract month will be the last trading day for the current contract. And the maximum order size is 500 contracts per order. Now, the main advantage of APEX fuel oil futures. One, we cover active trading windows of relevant markets, including Shanghai Future Exchange, Platts, and Intercontinental Exchange. Now, the published prices are actual traded prices, while the counterparties remain anonymous, meaning what you see is what you get. What you trade is what you're buying or selling. Secondly, the settlement is through physical delivery. And what happens is that physical delivery will happen at APEX approved warehouses. Now, the load-in and load-out inspection will be carried out by APEX appointed surveyors, while there is flexibility by a standardized APEX warehouse receipt. Thirdly, it is a small contract size US denominated contract, which embrace broader customer base, both commercial clients and retailers. This contract is suited for both commercial clients and retailers, and because of the small lots, 10 metric ton, it is suitable for precise hedging. Next, we'll touch on trading or how to trade on this fuel oil futures. Now you can see this APEX fuel oil and ICE gas oil versus ICE Brent futures. This is our correlation chart. You can see that there's a 0.999 correlation since our inception on the 1st of April. Comparing APEX fuel oil and ICE fuel oil swaps, you can see that the prices correlation is at 0.99 with an average spread of 70 cents. While our maximum spread is up to $10, our minimum spread can go negative 27.5. What you see from the screen, the graph, is that our prices are actually quite in line with fuel oil swaps, while you can see some gaps between 11th of April to 22nd of April, which means this is a time when arbitrage opportunities come in. And APEX versus Shanghai Futures fuel oil. Why we use Shanghai Futures fuel oil is because in China, they have launched this fuel oil contract. It's a similar contract size, 10 metric tons per contract. where traders, commercial clients or retailers, what they're doing is they're arbitraging against Shanghai futures fuel oil contract, which is denominated in RMB, Chinese yuan. This is our Apex fuel oil contracts in US dollar. So why trade on Apex fuel oil futures? Given a strong correlationship between Apex fuel oil and Shanghai futures exchange fuel oil, ICE gas oil, and ICE Brent futures, market participants, they can see arbitrage opportunities across the three exchanges. They can use our Apex fuel oil contracts as a proxy to other contracts, such as what I mentioned earlier on, whereby some of the participants, they think that Shanghai futures exchange, the fuel oil futures, is very interesting for them. They can afford to trade, but because it is restricted, in China. Only domestic customers they can trade on this, so they can use Apex fuel oil futures as a proxy to trade similar contracts. And we have physical delivery settlement for precise hedging strategy. And of course, for commercial clients, they can adopt our Apex daily settlement price and final settlement price as alternative pricing benchmark for physical contracts. Now back to hedging and arbitraging. I'll first start on physical hedging, whereby this applies for commercial clients. What happened is that clients with intention to trade for their physical requirements may trade on our fuel oil futures. The advantage is that this helps to refine their fuel oil procurement process and of course risk management. Below, I'll show one example of how our fuel oil futures can help to facilitate physical traders, commercial clients to better manage their procurement process. So we have company A and B. They had their budgeting on their operational costs in September 2019. Now they will require 2,000 metric ton of fuel oil and have to purchase it at below $415 US dollars per metric ton in order to maintain their profit. So fuel oil futures is selling at $411.8, $411.80 per metric ton for September, which you can see on the right side, our code FO1909, which stands for September 2019. It is last traded at 411.8. So company A, they decide to not hedge. They want to leave this procurement to market risk, while company B, they decide to hedge with our fuel oil futures. Now what happened is, for now it's only July. We won't know what fuel oil price might be in August or in September. So buying this is similar to buying an insurance to your operational costs. You're hedging the risk, you're maintaining your profit. So let's see what happened. So come September, when both company A and B, they decide to buy their physical cargo, the fuel oil prices rises up to $430 per metric ton. Company A would have incurred a loss of 30,000 US dollar. While company B, they have retained their profit because they have hedged their requirement at $411. In fact, they have even made some profit because they hedged their costing lower than their budget requirement. Now, some of the traders or participants, they might argue that, right, I'll leave my position, I cannot hedge, and what if the price goes down? Yes, you do make money. You do make money when the prices goes down, but since right now you already have your budget and you are presented this opportunity to hedge your fuel oil and you can maintain your margin, why not just hedge it and then take the profit and don't let your operational costs get eaten up by the market fluctuation. Next, we'll move on to arbitraging. Now, clients with intention to arbitrage, they may wish to trade fuel oil futures against Brent, against swaps, against gas oil, and against Shanghai futures exchange fuel oil contracts. Now, I have two examples over here. So this is a chart that we have formulated, we have recorded during 3rd of June to 7th of June, whereby there's a clear arbitrage opportunities that you can see. On the right side, on the left side of the columns is Singapore 380 swaps at 5:30 p.m. While on the right side is our Apex fuel oil futures on 5:30 p.m. from 3rd of June to 7th of June. Now, example. Now, company A is waiting for arbitrage window to open, and there was an opportunity on the 4th of June 2019. So as you can see from this highlighted blue circle, 4th of June, they are looking at August. So August price on 4th of June is at 351, while our September price is at 357. Now, I think some of you have questions in your head right now on why we buy swaps and we sell futures, we sell 1 month ahead. Well, because the settlement of swaps is on the last day of the contract month, which means the settlement for August is on the last day of August, while our settlement of fuel oil, Apex fuel oil futures is on the last day of the previous month. So which means our last day of settlement for September contract is in August, is on the last day of August. So to do this arbitrage, we will always look to buy swaps for the month before the fuel oil futures contract month. And some of you might have questions on why do we look on 4th of June? Why are there no opportunities on the 3rd of June? Well, you can see our fuel oil contract, our Apex fuel oil contract is usually a couple of dollars higher than swaps. You can see on the 3rd of June, the August price versus our September price is $1.70 difference. So across through our records, a couple of dollars is what the market is moving right now. So why 4th of June is that there's an obvious arbitrage opportunity. There's a $6 difference between August and our September price, 351 versus 357. So company A say they bought 2,000 metric ton of August Singapore swaps, and they sold 2,000 metric ton of Apex fuel futures. So what happened is, as the market converged on the 7th of June, company A decides to unwind both positions, selling swaps and buying futures. As you can see, the orange color circle on screen, on the 7th of June, there is in August is a $363.5, while in September it is 361.2 for our futures. So you can see from the screen whereby we did a calculation for whatever position that they're unwinding, they have a gain in swaps, which is 363.5 minus 351, because they bought at 351 and they sold at 363.5. So multiply by 2,000 metric tons, they are making $25,000 on swaps, but they are having a loss in futures because they sold at 357, but the market rose up to 361.2. So multiply by 2,000 metric ton, they are making a loss of 8,004. But overall, after the market converged, there is a net gain of $16,600 for company A that made use of this arbitrage opportunity. When the arbitrage window opened up, they went in and executed the trade. Now, another example will be the arbitrage opportunity between Brent and fuel oil futures. Now, this is a record that we have calculated. We have recorded down from 3rd of June to 13th of June, the Brent settlement versus our fuel oil futures settlement. Now let's use back company A as an example. So company A was waiting for arbitrage window to open, and while looking at the market, they have chosen 6th of June as an entry point. So on the 6th of June, they chose to come in and do some arbitrage between Brent and our fuel oil futures. And to optimize the co-relationship, company A actually calculated 2,000 barrels of Brent to be similar to 310 metric ton of fuel oil. As you can see from the conversion, the market conversion is that one barrel you multiply by 6.35, that should be the correlation between barrels to metric ton conversion for crude oil to fuel oil. So company A, they bought 310 metric ton of fuel oil futures and they sold 2,000 barrels of Brent on the 6th of June. So if they decide to unwind both positions on the 10th of June, buying Brent and selling futures, it will result in a gain in futures because market went up. Yes, they bought at they sold at 365 and they bought at 355.2 multiplied by 310 metric ton, which is they had a gain on $3,038. While there's a loss in future, loss in Brent, whereby they bought at 62.29, but they had to sell at 61.67 cents at 2,000 barrels, which will result in a negative $1,240. However, after you do the calculation between these two, there is a net gain of $1,798. So why? So questions is that people will say, is fuel oil always stronger than Brent? Well, based on historical data, yes, fuel oil is stronger than Brent. It's always stronger than Brent. Now, let's take another example. If they decided to not close out their position on 10th of June, they decided to close out their position on the 12th of June. What happened is that there is a gain in the futures. They are buying at they're buying at 355.2, but they are selling at 348.9. So what happened is there is a negative of $1,953 on their fuel oil futures, and the gain in their Brent is that they sold at 61.67 while they bought at 59.97. So times 2,000 barrels, that will be a gain of $3,400. So after netting off and calculate, there's a net gain of $1,447. So these are two very basic examples of arbitraging between fuel oil and Brent and between Singapore swaps. So hopefully this short example can give you guys a clearer idea of how fuel oil futures can be used to arbitrage against different products. Last but not least, thank you for your time, and we are open for question and answer now.
Yes, if you guys have any questions, please type it into the Q&A box and we will answer them. We will give you 5 more seconds, and if you have no questions, then we will end the session here. Okay, thank you once again for attending this webinar, and in case you have any questions, please feel free to email us or call us at our hotline. And we will end the session now. See you next time, and goodbye.
Thank you.
Thank you.